long-term money we'd usually define as money you don't think you're going to need, even though you could get it back, but you don't think you're going to need for 5 years or more. And in a project like retirement, that's a super long-term project that's way longer than 5 years. Really think of, the easiest cut is to think of short-term emergency money, keep that in the bank, and long-term money to invest in long-term assets like stocks, bonds, and mutual funds being a way to easily access those. And the question would be, well, why would I put my money at risk in long-term assets at all? And the short answer is inflation. If you don't invest in long-term assets, you tend, based on history, to have almost no chance of keeping up with inflation. It's important to remember that if you don't invest and inflation keeps eating away at your money, then that itself is a permanent impairment of capital and is to be avoided. And you contrast that with what people sometimes might think of as risk, which is the bouncing around in price of long-term assets like stocks, and certainly not to minimize the discomfort some people can feel from that. But if you're stacking up which risks you want to take long-term, our view is everywhere and always, the bouncing around in price of otherwise good assets at good prices should concern us a lot less than the possibility of way underperforming inflation or running out of money, or as they call it in the pension business, shortfall risk over the many decades of saving for retirement. So, there is nothing in life that doesn't have a risk.